Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:18 a.m. Central Time, and I'm recording this in preparation for the market day of October the 21st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's see what we got going on here with the morning report. First of all, I'm generally bullish. All four broad market indices in the United States are up, and they're all up about the same, about 0.5%. Crude oil down about 1.23%. The euro up just marginally. Bonds up about 1/3%, and gold is scratch. In terms of overseas action, China is down 3%. Hong Kong was not open. Japan up almost 2%. Germany up almost 1%. United Kingdom up about 0.5%. In terms of the macroeconomic reports for today, you have crude oil inventory in its usual place on Wednesday morning. And that looks to be about it. On tomorrow, let's see here. Nat gas storage, existing home sales, unemployment, the weekly variety. That seems to be about it. So pretty quiet there, and really a pretty quiet week all the way around on that aspect. Okay, in terms of volatility, we had a little mixed action yesterday. Short-term volatility's up just a little bit, 15.01. Skew continues to be elevated. This is going into the second week in which we've seen these really high skew ratings. And I noticed a report yesterday that both large institutional buyers as well as small investors are both buying a lot of puts compared to the amount of calls that they are buying. So there seems to be kind of almost a universal concern with this rally from all buyer parties. So kind of keep that in mind. IV percentile 17, 16, 17, and 18 across the four indices. Nothing really of note there, all very, very low. No standard deviation moves were put in yesterday, and we've now gone several trading days without a standard deviation move being put in. So pretty small action. And if you look at the chart, you know, these are pretty small candles, small bodies. Not a lot of momentum being able to follow through on either side. In terms of the regular daily report, we do have a couple changes here today. IBD status remains confirmed uptrend. Accumulation distribution score on the S&P chart at B, though the Nasdaq remains a very weak D-. GMI index improved to 6 out of 6, and its buy signal has been in place since 1019. Primary market condition is still a weak bear. Stock chart decision points have not changed. So we're still mostly in down arrows with the intermediate and long term. And the intermediate term market posture is still in a very bullish posture with an upslope sentiment. So consensus on across all these different mechanical signals is that we are still in transition, but much improved conditions from what we had a week or two ago. Position sizing opinions on both systems are still at 100%. On the intermediate term market posture, very bullish. S&P 93.6, Dow at 94.6. Nasdaq is on the verge of going into the very bullish camp at just below the 80 threshold, and the Russell is still bearish at 68.7. Hedge warning status remains level 1, so some elements of elevated risk still present in the market. So consider that a yellow light and have some caution. It's not all bull all the time at this point. In fact, we had some new warnings come in play yesterday. There was a market in decline and a sharp increase warning, both flagged yesterday with the close. So that's something to note. Also, the Nasdaq is now at 4 distribution days, and at 5 that goes into warning status. So in relatively short order, we have stacked up once again, and this seems to be the theme of 2015, where we get the confirmed uptrend signal from IBD, and our count starts over on the distribution day count, and then in no time at all it deteriorates and falls back apart. And remember, we are in the ninth confirmed uptrend signal for 2015. The prior 8 all failed, and all failed in relatively short order. So this has been a very difficult year for bulls to get follow through. And this seems to be heading that track again. Though you still have to say there's an awful lot of positive things in the various signals. So we continue to have a case for both the bulls and a case for the bears, with not a lot of resolution to either side. Skew, as I mentioned, very elevated, and it's currently sitting in an area with a 13.1% probability of a 2 standard deviation move within the next 30 days. So that's also a concern. New highs, new lows yesterday was very strong. The bulls definitely won this one. 454 new highs compared to the new lows of only 46. In terms of the intermarket risk aversion indicators, we have now 4 at risk on and 1 at neutral. That actually improved, and some of these actually saw some good angle and separation yesterday. So that was largely one for the bulls yesterday. In terms of special opinions, no changes here. Option income strategies. VIX is within the acceptable window for novice traders. Consider reduced position size and potential for higher than normal delta and vega moves given the current skew levels and the intermediate term bearish cluster formation that we had a few days ago, which really hasn't followed through quite yet. So there's a couple warning signs that we could be due for something of a pullback. We really haven't had much of pullback, just mostly doji and hammer kind of formations without any kind of confirmation on pullback. Cover call strategies, conditions are cautiously bullish, acceptable to initiate new positions for the novice traders, and relatively aggressive, and probably the most aggressive it's been here in a while. 2-to-1 ratio of out of the money strikes versus in the money. I still need to correct that. 2-to-1 with 2 going to out of the money strikes and 1 with in the money. Also 2-to-1 ratio of higher beta versus lower beta. You might want to consider until you get through some of this resistance that you might want to take a little bit more defensive posture, and that what you go into perhaps is something that will be able to withstand a pullback. You can also, of course, always leg into cover calls through using out of the money put selling, and then always consider size, the position in which you take, that you are willing to own those number of contracts. And indeed, with put selling, conditions are generally acceptable. Consider defined risk positions when possible, and of course, aggressive traders consider scaling into full positions. In terms of sector specific, pretty green here on both the short and intermediate term, and starting to see some significant number of sectors that are going green into the longer term postures as well. So generally pretty good there. Notice healthcare still struggling. The biotechs took another hit yesterday. So this continues to be a bit of a troubled sector, though my personal opinion is that just be patient, and this sector will recover. They've taken some political heat of lately, but the companies themselves are fundamentally, have not changed, and it's really just a matter for this kind of pullback and consolidation to kind of find its support, and then the institutions are going to be interested in the growth these companies offer, and they can offer growth that is not available in some of these other sectors. So it will have its time. It's probably, if you're a value buyer, setting up for some potential opportunities. Not saying that time is now, and obviously, heck, like Walmart, you could have claimed after a 10 standard deviation move to the downside that was a value opportunity, only to see it continue to drop in the days following. So value buying is not my favorite thing, but certainly this healthcare sector and the biotech industry group in specific, could be an opportunity that if you were to come back, 3 months from now or some period of time in the future and look back at this and you would say, oh, I wish I had bought there. So kind of keep an eye on that group. Retail, of course, is the other one I just mentioned with the Walmart hit. It's also looks like it may be finding some bottoming patterns. That company certainly isn't going to be a hero anytime soon. The obviously wherever you are on wages, you have to accept that increasing wages has a very real impact to the bottom line, and that bottom line has been very much hit at Walmart, and that has taken down a number of their peers as well. So we'll see where that pattern goes as well. But those are the primary forces that have the weakness showing in these sectors. So kind of keep that in mind as to whether that might be an opportunity to itself. In terms of percent change, pretty mixed yesterday. Healthcare down 1.5% with the biotech hit. There was some earnings reports and so forth, and some individual companies that pretty much led that sector, that industry group down. And then on the flip side, telecommunications up, heading towards a percent. So kind of a mixed day, and indeed it was a mixed day on the charts yesterday. And that should be enough for today. As always, if you find what you're getting from here is helpful to your trading, we greatly appreciate you liking us on YouTube, subscribe to our YouTube channel, and then of course also retweet us to your Twitter followers, to your StockTwit followers. Email support at falconglobaltraders.com. We welcome your comments and feedback. And just some offers here. Quickly scroll through this. If you're more interested in the details, you can see the website here for this course, and then also the website here for a greater understanding as to what's offered at Falcon Global. Disclaimers as always, hit the pause button if you need more time to review this, and we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading!